Hello all, Bob Pisani in Malvern, Pennsylvania at Vanguard headquarters. Now I have a question for you. Suppose you own a mutual fund or an ETF. Now you bought and sold throughout your time owning these mutual funds and ETFs. Do you ever wonder what happened when you push the button to buy or sell something? Where does it go? Who handles it? Let's talk to the guy who actually does this. Mike Buek is the head of the U.S. trading desk for Vanguard. Been here how long, Mike?
31 years.
31 years you've been a trader, and you're the guy that the orders, if I have a Vanguard account, your orders go to your trading desk.
Absolutely.
Right? Why don't you walk us through that? Explain a little bit about how that happens. So suppose it's the middle of the day, it's 1 o'clock in the afternoon, and I want to buy or sell a Vanguard fund, and I push a button that says I want to buy $10,000 worth of a Vanguard fund. It'll come on your desk here, your people right behind me, and explain to me a little bit about how that order gets executed and when it gets executed.
So as an index manager, the golden rule is to be fully invested, 100% invested in the market, so we can give the investor the return of the index. So we monitor the cash flows. As you enter that order in the system, it comes through our systems, and we're monitoring throughout the day all the cash net inflow into the fund. And near the end of the day, 3:15 or so, we get a handle on that amount, and we run a trade list, which often matches the benchmark, and we trade that into the close.
And it's a very important point about mutual funds. The orders get executed at the close. So if I put in an order at 1 o'clock, that order is not executed at 1 o'clock. It's actually executed at 4 o'clock for the mutual fund.
Yeah, the NAV of the fund is valued at the closing prices of all the underlying stocks. So you basically buy it at 4 o'clock. And for us to match a benchmark, we monitor that cash flow, and we actually put the cash flow to work at the same price near the close.
Yeah. So explain how you aggregate all of the orders. So throughout the day, you have dozens and dozens of funds here, tens of millions of dollars go through here to buy or sell. How do you aggregate everything at the close and do you actually get a list of all the stocks you have to buy, stocks you have to sell? How does it work at the close?
Well, we see all the flows into the various 100+ funds we have here at Vanguard, and each fund is tracking a different benchmark. So, for instance, the Index 500 portfolio is tracking the S&P 500. We may have $200 million of flow coming in today. The portfolio manager will get that amount and run a trade list versus the current portfolio versus the actual index. And often we'll trade 350 to 400 stocks.
Of the S&P 500.
Of the S&P 500.
Yeah, that's like 70, 80%.
Exactly.
So you actually have a list. I need to buy this much of these stocks, sell this much of these stocks.
Yeah, and of course we're buying Apple and Exxon every day.
And where do these get executed? You use brokerage firms, but you don't use one brokerage, you use many brokers.
Yeah, we probably have about 30 brokers we use, and our traders actually do the trading. We route through the brokers' lines to the New York Stock Exchange and to NASDAQ directly, but our traders on the desk are the ones actually sending the list out directly to the exchange. It may be through Morgan Stanley's or Goldman's wires to the exchange, but our traders do the work.
Now these are indexing funds that you're talking about, and Vanguard's big in indexing, but Vanguard also has a lot of active management funds. What happens, you have active managers who are making decisions throughout the day, I'm going to buy this or sell this. Do they get executed, their buy and sell orders get executed similarly, or how does that work?
No, I imagine the active managers here at Vanguard do monitor their cash flow, so they want to have an understanding of how much cash is sitting in the portfolio, but they don't have the urgency to be 100% invested the way an index manager has. So my guess is a lot of active managers may have 5-7% sitting in cash already. They look the next morning to see what they have, and they put it to work at that point. But they don't have the same mandate as an index manager.
Let me talk about what's been going on the last couple of months. We've seen a lot greater increased volatility in September and October. Did it feel different? I mean, we had days when the volume was, twice normal volume. We saw days like, was it October 10th? The Dow was down 900 points. What was it like to be on the desk at that time? Did it feel like things were much more volatile? Give me a sense of what it was like to be here.
I feel like 2016 and 17 were an anomaly of stability. So we kind of gotten used to a real stable environment, grinding higher every day. So I feel like 18 in October and November actually felt worse than it really was. It was a little bit going back to normal. But on the trading desk, our key is really to monitor our cash flows. And our clients here at Vanguard really didn't panic. In fact, we were net buyers. So basically
on that day,
process.
October 10th, when we were down 900 points, Vanguard was a net buyer.
We were definitely a net buyer. And our clients tend to do that. They aren't panicking. They stay the course. They're diversified.
And you're not sitting there making your own decisions. This is you're managing the index side of things. So these are investors deciding buying low. The market's down. They're buying in.
Absolutely.
Yeah.
So our same process really didn't really change due to the volatility at 315. We watched the cash flows. Yes, they were to buy. We ran a trade list. We bought near the close like we always do.
Now we of course talk at CNBC all the time about index versus active. A lot of active managers come on our air and voice their disagreement over the growth of indexing. They think that it's going to cause problems for the market somehow. They rail against ETFs and the growth of indexing associated with ETFs. Do you see any concerns about the growth of indexing at all? Is there some point where it might grow too big? How do you respond to people who say indexing has become too big a part of the market?
Well, globally, indexing may only be about 15% of the market cap. Still very low relative to the entire market cap. And indexing has really caught on because the low cost and the diversified, the performance has done better versus high cost active funds. But at this point, at 15%, it's not close to causing a problem. I don't know where that might be, but price discovery in the market is as good as it's ever been. With technology and active managers just prowling to try to outperform. Alpha's hard to get, but a name like Facebook in the summer, I forget what it did, had bad news, dropped 19% like in a second. The index funds didn't trade anything. So price discovery is still as healthy as it's ever been. Clearly indexing can't be 100%, but we're not close to a point where it's causing any problems because price discovery is still extremely healthy and alpha's hard to find.
You mentioned that big drop. We see other kinds of investors that are out there, quant funds, for example, that might be much more active investors moving things around. And occasionally we get people on our airs talking about the machines are taking over, that algorithms control everything. You're a guy who sits here on the trading desk every day watching big levels of trading. How do you sort of fight against that, this vague feeling that somehow there are dark, unseen forces that control things out there? What's your thought on any of that?
I think a lot of the moves are fundamental, and information is out there that has driven some strategy to sell. And every sell, there's a buy on the other side. So there's some value manager that's deciding it's time to buy Facebook down 18%. But there's this feeling that you want to know who to blame. Why did the market drop 6%? And maybe because interest rates went up and earnings aren't coming through, and we're worried about the Fed raising rates further. I don't know what it is, but it seems like everyone wants to know why, who did it. Recently it's been a lot of, it's index funds because index funds are big. Believe me, we didn't affect Facebook, and that market drop day we were buying. And indexing is a very small percentage of the market. 7 years ago it was all high frequency traders that did it. But right. I think there's just a need for people to point the blame at somebody. And a lot of times there's a lot of factors involved. And I know you need the quick, here's why it happened, but it's hard to really find the answer.
Before I let you go, one of the things that I really do appreciate is how much more efficient trading has become through technology. I want to point out, this is the Vanguard trading desk behind me. This is essentially it. If you can pull out, Mike, and just show the whole thing. How many people we have here on your trading desk that work for you?
We have 22 index portfolio managers and traders on the desk here. We have 15 in the UK and 15 in Australia.
Now, you trade dollar volume, how much a day?
On an average day, it's about $2 billion. But if we didn't have any cash flow and there wasn't any index changes or corporate actions, we wouldn't trade a dollar. Typically, we have cash flow coming in, so it's about $2 billion a day. But on a big index change, a big rebalance, we've traded $60, $70 billion globally. So it really depends.
That's when, so there's stocks going in and out of the S&P 500 on a quarterly basis.
Exactly.
On a big day like that, you might be. But on a typical day, might be $2 billion.
$2 billion is about normal now.
Yeah, but that's still a lot of dollars, 22 people. The point being, the technology has dramatically improved in the last 30 years or so.
30 years ago, we would need 100 people. Now, a lot of it is just done electronically with baskets, and you don't have to, before 15 years ago, you used to have to negotiate all the NASDAQ trades. Now you can electronically route them.
Well, there you go. The trading floor of Vanguard, 22 people doing at least $2 billion, and some days 60 billion, you said? Okay. Mike Buek, Head of Trading at Vanguard, thanks very much for joining us. Bob Pisani in Malvern, Pennsylvania at Vanguard headquarters. Everybody have a healthy, happy, and safe trading day.